It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everybody. Welcome to the show today. Happy Mother's Day to all of you out there who are mothers. And again, a special happy Mother's Day goes out to my mom. Thank you so much for being amazing in every possible way. All right, today's date, Sunday, May 11th, 2014, and it's time to talk about the markets. Let's figure out what's going on here. Markets last week, net pretty much flat. We did see the Dow Jones Industrial Average moving up and closing at a new all-time high on Friday, but that's a little misleading, and I want everyone to understand exactly why. All right, so let's talk about the Dow here. The Dow is 30 stocks, first of all. And what kind of stocks are in the Dow? Well, you got DuPont, you got Hewlett-Packard, you got IBM. In other words, you have a lot of old school stocks that have been around for a long, long time. And these stocks, folks, these stocks are the old school dividend payers that have been around and will be around for a long time to come. So the point here is to understand that the Dow Jones Industrial Average is a flight to safety index. And again, it's not to say that the markets had a big drop last week. We saw some whippy action for sure. Net, I think the S&P was flattish on the week. We saw, again, the Dow up a little bit. And I think the NASDAQ lost a little bit. So it was really a mixed week last week. And, the key is, again, to recognize that you don't want to get too hyped up and think, oh, this market's amazing. Why? Because the Dow hit a new all-time high. And I think that's where I want to start there today and just have everyone really understand what the Dow is. All right, if you're an investor and you've been in biotechs, if you've been in the technology sector, especially this last week, we're going to talk about it a little bit later, but some of these technology stocks absolutely got rocked last week when they reported earnings that just were not up to par. And we're not talking about 10% drops. We're talking about some stocks dropping 20 to 25% of their value in one single day. And that was all going on while you saw the Dow Jones Industrial Average inching up just a little bit. Okay, and again, closing at a new all-time closing high there on Friday. So bottom line is, what did we see last week? Well, when all was said and done, as I said, the markets were flat. We had the Dow at a new all-time high, but I want to go day by day. And one thing I've talked to you guys about going day by day, which is super, super important, is to understand that markets overall have violations and movements intraday that are very telling about the overall action out there. So if we look at each individual day and compile it, you get a sense. It's a better sense than if you would just look at the closing prints. Now, I know a lot of you guys work 9 to 5. A lot of you guys do not have the opportunity to kind of watch the markets intraday. And that's where I come in, where I can kind of feed you the intraday action. And by listening and watching the intraday action, as I said before, you're going to get a good sense about the overall market, much better than you would from listening to the CNBCs out there or the Bloombergs or any of these other media outlets that just kind of spew the hype. And if you guys know about this show here in the Money Stock Market Action on 820 AM News Talk Radio, the one thing you guys know is that I'm all about just telling it like it is. I don't want anyone getting misled. I don't want anyone kind of being sugar-coated here. This is what the market's doing. This is what you need to prepare for, and this is how to make money. Simple as that. So let's go back to last week and discuss the intraday action. And again, if you look at Monday, right? So last weekend we had a show. Nick was on it with me, my chief market strategist, business partner at InTheMoneyStocks.com. And we talked about what to expect in the coming week. And we talked about volatility, but really thinking that the markets overall would chop sideways for the coming weeks until we get a bigger correction down the road in a few weeks. Now it's a little closer since we're 1 week through that. But coming in on Monday morning, the market saw a large gap lower. So right off the bat, it didn't look pretty for the markets. But this is where things got really interesting, and this is going to lead me into my next point about where the markets reside and what it tells you about the future of the market. All right, so we had a big gap down on Monday, and the markets inched higher and pushed all the way up by the end of the day to close positive. So right off the bat, you look at that reversal and you say, wow, that's impressive, the fact that the markets were able to reverse. So after Monday, you go into Tuesday and you're thinking, all right, well, that was some strength in the market, so that's not such a bad sign. Well, Tuesday, we had a small gap lower, which is just a small minor, a couple points on the S&P open lower at 9:30 a.m. Eastern time. And the markets started to float lower, and they sold off all day long and went back to Monday's lows. So now you have two contradicting days. And as a trader, you have to be able to read into that and understand what it means. Because as a trader, like what I do and what our members do, we're trying to make money in very short time periods. So we need to know what the market's going to do in the coming day or the coming week. All right. Now, with two contradicting days, you have to start formulating your opinion and saying, listen, the market may be putting in a pivot here. What's a pivot? A pivot is a decidedly large move on the verge of occurring. So, for instance, think about a pivot. So you're on the edge of a cliff, right? You could either fall over the cliff or you could stay on the cliff, one way or the other. Or you're on the side of a mountain. You could go down one side or you could go down the other. That's a pivot right there. And a Monday that reversed to the upside, which was a strong showing, and a Tuesday that sold off, starts to give me, and that's what I was telling our members all week long, that you might have something in store here that is putting in this pivot that we need to watch for. And why do we need to know a pivot's coming? Well, because ultimately, if we can gauge the direction of the next big move, there's a ton of money to be made. So sure enough, after Tuesday's sell-off, I started to watch for what was going to happen on Wednesday. Now, Wednesday was an interesting day because you had Janet Yellen testifying in front of Congress. And Janet Yellen is the Federal Reserve chairwoman, and she took over from Ben Bernanke just a few months ago, and she's already cut QE back like they've been telling us they would by $10 billion in the previous few meetings. And now they're printing about $45 billion per month that's being infused into the economy one way or the other. Now, she's generally been a very big dove, which means she's been a market-friendly indicator. She's talked very positively about the economy. She said we're not going to hurt the markets. We're going to do whatever it takes to keep things afloat. And sure enough, initially, early before she started talking and after her just initial comments were read, the markets sold off pretty sharply. And we saw a 3-bar surge in the early morning period. By the way, 3 bars are referring to the candlestick chart. A lot of you guys may not know what that means, but it's actually a term that shows you a reversal or bounce could be in place. And we obviously in the intraday stock chat were able to isolate that down into support and play it for profits. But bottom line is early selling, but once she got in front of Congress, she started to talk perfectly. She smoothed everything out. She kind of took that gentle hand and cushioned the markets. And the markets, after early selling, started to float back up. And we went back up and rallied for the rest of the day. So now you have a reversal day Monday, which closed positive, a sell-off Tuesday, which was right back down, and a Wednesday that after early selling reversed and went back up. And this continues to put the thesis that I had early in the week into play that the markets were now putting in this pivot point. All right, what happens on Thursday? Well, she testifies in front of the Senate Budget Committee. Markets into that were rallying because she already helped the markets rally the previous day, and this is where things get very interesting. So right around midday, she's done testifying. All right, she's done. The 2-day testifying is over. The markets throw it out. Enough is enough. Now let's start focusing on the reality of the situation. And we saw the markets begin to inch down a little bit. Now, there was a bond auction that came out in the early afternoon on Thursday. And this is where the market started to get a little bit scared. Because the bond auction had a horrendous result. No one wanted to buy our debt. Now, why is that an issue? Well, the only reason the Fed has been able to push as much money, including $4 trillion over the last 5 years or so, into the markets and into the economy is because other countries have been willing to buy our debt. China, Japan, various other countries out there. So if no one's willing to buy our debt, could there be trouble lurking? And I think that's something that we have to talk about today because I think that bond auction is probably one of the main things that even though the markets, again, on Friday kind of went sideways and closed slightly higher, and again, the markets for the week were basically flat, the sell-off from the highs on Thursday back down off of that bond auction, while forgotten very quickly by the markets, for us gurus, for us pros, is something we need to pay attention to. All right, if the way the market is able, and the way the Federal Reserve, the way the government is able to fund itself right now with such a big deficit is by getting money from other countries. We sell bonds, they get an interest rate, we get their money. We spend it, the government spends it anyways, and that's the way it plays out. If countries start or cease buying our debt, it could be setting up for an epic collapse down the line. Now, by no means do I think that this bad bond auction is the start of that right away. or at least not the end-all, be-all collapse scenario. That's not what I'm saying here. I'm saying this is a warning shot across the bow that we as investors need to just pay attention to, just put it in your Rolodex, put it in your file cabinet, and remember it happened. So in the future, when we start seeing this happen a little bit more often, we remember what this happened here, and we can ultimately position ourselves for that bigger move down. Now, projecting out to next week. All right, so that was this week. This week, again, choppy action, lots of reversals. Markets tried to go higher. They got pushed down. Markets tried to go lower. They were rescued. And again, that tells me that my theory, my thesis was correct, that the markets are at that pivot point. They're getting ready to make a turn. Question is it up in dramatic fashion, or is it down in dramatic fashion? Okay? And we should know the beginnings of that move, I would say, by Wednesday of this coming week. All right, I think that Monday, again, assuming nothing crazy happens, you could see choppy sideways action, maybe even the market floating up. But really what you're looking for is a breakout of the range. If you look at the S&P chart, all right, throughout the course of the week, you're going to see highs in the general same range and the lows in the general same range. What you're looking for is a breakout or a breakdown from that range, and that will give you the direction of this next move in the markets. So again, going into next week, generally based on a couple trend lines that I've shown our members at InTheMoneyStocks.com that we're currently below, I have a negative bias on that. Okay, and that's only because the technicals of the charts are telling me that. Now, if we get above a certain level, I could very easily say, okay, the short-term move is going to be up here. But right now, the positioning, the fact that we made a lower recent low than the last low, all right, these signals are telling you that there's a good chance that the markets will head lower off of this pivot. All right, so again, keep that in mind. I'm going to continue to tell you to be conservative on your portfolios. By the way, this is the short-term move. Weeks out from now, we're going to start to see a bigger move to the downside. Even if we were to move up in the short term, let's say the markets reverse Monday, Tuesday, and break out, that's just a short-term move. The grand scheme of things is not something you want to be long in. Don't get confused if you do see upside, because a lot of average investors, this is an issue that most people have. They see the short-term move and they say, oh, this market's going to go to new all-time highs. Or they say, oh, look at the Dow, new all-time highs. And they don't realize that the Dow is the safe stocks, that money flow is coming out of the NASDAQ, the high-tech, high-beta plays, which again are the risky plays that pay you a lot, and money's flowing into these safe havens. And if money flowing into the safe havens, obviously each and every one of us, when I say it that way, you should know that's not a good sign for this market. Okay, so net, long-term view, negative on the markets. Short-term, slightly negative. But again, if we break through a certain technical line, then it could be a short-term just positive. And it's just a blip on the screen. In the scheme of things, a little bit of upside and then reversal down, or we just head down right away. And I'm going to be watching for that and trading for that accordingly. I did pick up a short on Friday. I ended up shorting Qualcomm, QCOM. Beautiful. I mean, if we just flip to and again, you guys don't have charts to view here, but for those of you that are at home that have your charting platforms up and are trying to follow along as we discuss these charts, if you go to your daily chart of Qualcomm, all right, there is a beautiful, and I repeat, beautiful bearish pattern here on this chart. A beautiful bear flag, what we refer to it as. Is there a small chance it could go up a little against us before it pays us big? Sure there is. There always is. But ultimately, the flag pattern is there. The inside bar action from a gap down is there from earnings. By the way, we were short going into earnings, made good money on it, took our money. All right, and remember, short is when you are against the market. The market is going to go down, we think. And that's why we would short the market or individual stock. In this case, we were short Qualcomm, which we were betting it would go down. The stock gap down on earnings. We took our money off the table by covering that short position. The stock then floated back up for about 2 weeks, and now we're looking to short it again as it's almost back to our original short level. And that's what swing trading is all about. Swing trading is about going long or short a stock in a short amount of time, and you're just looking for that quick move, and then you move out and wait for the next setup. So you're looking, I mean, it's weird because it's very counterintuitive. Most average investors saying, oh, quick move, I guess I'm not going to make much money on it, like 1%. What's 1%? Wrong. The way we find our setups, and this is so important, the way we find our setups is that literally you should be in the short term getting paid 5 to 10%. And if you look at our track record for 2014, it's basically 5 to 10% winners, some bigger, some smaller, but generally 5 to 10% winners. And we're talking about a hold time of 1 to 2 weeks probably on average, maybe less. I still remember 2 weeks ago, DANG, which is a Chinese stock, and we picked it up as a long play off a gap fill 200 moving average. And that was just a beautiful, multifaceted setup for a long play. And in 24 hours, we banged it out for 10%. And that's what you can do sometimes. I mean, sometimes, as I said, you're in for a short amount of time and you're out, or you're in sometimes a couple weeks and you take it off. And listen, there are losses too. But the point is you want to keep your batting average at around 80%. And I think right now we're hovering around 90% in the Research Center, which is our main service for swing traders and investors. 90% winners, folks. Think about that. All right. What I want to do here, folks, is we're going to take a break here. When we come back, we're going to discuss more on this Mother's Day. And again, a happy Mother's Day to all of you mothers out there on this Sunday, May 11th. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And right now you are listening to In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. Great to be with you again on this Sunday, May 11th, 2014, and a happy Mother's Day to everyone out there. First of all, when we get back into the markets here, I want to discuss a little bit about the key factors from last week that could tell us where certain markets or stocks are going in the coming week. And, number one, I think one of the big stories that broke late in the week was that Apple might be buying Beats, which is the headset, the earphone maker. And that price tag on that, an astronomical $3.2 billion. Now, again, the deal apparently isn't 100% done, but the talk is out there that this is pretty much in word deal that's been completed. And again, what does that mean? Well, first of all, Apple has not bought anything in ages, especially not at this valuation. Now, it's interesting because if you look at Facebook just bought WhatsApp for $19 billion. They've gone out and bought lots of companies for multiple billions of dollars. But Apple has always been a company that has grown products from within. So you have to ask yourself, what does this mean? I mean, is this Apple kind of throwing its arms up in the air and saying, listen, the innovation, we just can't do it. We don't have the people in our organization anymore to really innovate something brand new and hot and hip. And again, could that be why they're going after Beats? Now, the other aspect of it could be that it's more for their music side of the business in terms of their online kind of Pandora type, and we all know what Pandora is, right? That's the online music player that you can listen to music live streaming. You can choose any genre you want. You can say, hey, listen, I want to listen to classical or hip hop or anything like that, and you get a commercial here and there as long as you're not a premium member, and therefore you get to listen to whatever. It's kind of like an online radio station, to be honest. So the question there is Apple telling us that there's no innovation within Apple, or is Apple starting to build out a competitor to Pandora? Now, initially when this news broke, people said, oh, listen, if it's a competitor to Pandora that's coming through here, this is going to be a negative for Pandora. Okay, and that was the initial reaction. And you saw Pandora, I think it was on Thursday morning, start to trade sharply lower. All of a sudden it was looking to open down 3, 4, 5%. And remember, Pandora's already off some crazy amount. In fact, let me just bring up this chart so we can kind of gauge it together. So Pandora, get this, guys, topped out at $40 in late February, early March. $40 per share. Right now, it's currently trading at approximately $23. Now, on Friday, it was up about 3.5% off of this news here. And again, on Thursday, it was kind of a little bit of a doji put in there, a little bit of a bottoming signal as well. But point is here that initially, the negative vibe was that this was bad for Pandora. Competitor. Uh-oh, here we go. Apple, the big boy here, is going to be a competitor. But what people started to realize, and this is very important, is that the valuation given to Beats may, in fact, up the valuation of Pandora as a sympathy play. So if you look at Beats, right, and you look at what Apple's paying for, and Apple's paying $3.2 billion, then in theory, if you translate over to what Pandora has, Pandora's valuation goes up, and therefore their stock price should go up as well. Okay, and again, I just want to say this to you guys, and I think this is something very important that most average investors don't understand. The market cap for Pandora, one of basically the most popular by far online radio station that plays music and streams music, any type of music you want, $4.65 billion right now. For Beats, which basically is a hip headset for listening to radio, $3.2 billion. Now, look at those numbers side by side. Obviously, Beats is a little bit less, but Pandora has 10 times more. So the thought process here and why it rallied nicely and continued to rally after hours on Friday is that the valuation of Pandora should be higher. Now, again, if market conditions sour, who knows? But right now, Pandora is getting interesting to me. Now, I'm not in it right now. I am not in it right now. I purposely will not be looking to buy it. I have a buy level around $18. But if the market sours and we see some good selling in this market, I do think Pandora still could be forced down to that $18 level. But $18 is an awesome level on Pandora. Right now, trading around $22.50 to $23 per the close on Friday. All right, so that was one little tidbit I wanted to just bring to your attention. And this is why it's important, folks. You can't just hear something from the media and just think, oh, well, that's the truth. That's what I have to go off of. Start thinking for yourselves. Put two and two together. Say, all right, listen, there's talk that this is a bad thing for Pandora, but is it really? I mean, what was the valuation of the Beats buyout? So things like that, again, guys, I just strongly encourage you to look at and understand. Now, let's look at a couple other big news stories here. First of all, I think we have to talk a little bit about some of the stocks that got beaten down last week. I mean, you saw Whole Foods dropping 20% on earnings, AOL dropping 20%. I mean, these are stocks that are huge companies. Tesla got rocked. I mean, last week alone had a humongous drop after they reported earnings. And again, it wasn't that, and this is the key, guys. All right, so Tesla, I think on Thursday was down about 10+%, maybe even a little bit more, which is a huge drop for a company that's valued at $25 billion prior to that approximately. But this is the issue here, and even a stock that I had some, and I actually took a loss on this week, FEYE, which is a security firm, an internet security firm. They reported earnings, and they just got hammered, absolutely annihilated. So what's going on here? Why are these companies that report earnings actually beating earnings are still getting hammered? And I'm going to discuss that in the next segment. So at this point, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
All right, back for the second half of the show today, folks. And again, today's Sunday, May 11th, 2014. Happy Mother's Day again to all you mothers out there. And again, as I said at the top of the show, happy Mother's Day to my mother out there in Oregon, Portland, Oregon. And just going into the markets today, folks, you have to look at something I just mentioned before the break. So you have a weird divergence here. All right, number one, Chevron. Let's talk a little bit about Chevron. Chevron's an old school stock, pays a dividend, safe play. And this is in the Dow Jones Industrial Average, which kind of explains why the Dow has been doing so well lately. Because, again, money flow has been going into this stock for safekeeping, essentially. Now, a couple weeks ago, Chevron reported earnings. They missed on revenue. They missed on earnings. They just honestly aren't finding as much oil as they used to. I mean, it's a stock that it looks like it's in decline. I mean, I don't know how much oil is left out there for them to find, but ultimately, every quarter, they seem to be losing some revenue or some earnings. Now, they're still making good money, don't get me wrong. They're still making more than their fair share. But why did that stock basically go neutral to higher on earnings when they missed? And you have stocks like AOL, Whole Foods, FireEye, Tesla, and the list goes on that literally dropped 10, 20, 25% on earnings when a lot of these stocks actually beat on revenue and beat on earnings. So you see the divergence here? One stock misses and it goes up. The other stocks beat or at least come in around, or even if they miss, they still get crushed by 25%. The answer's simple, folks. I mean, right now, investors do not want to hold technology. If you remember back in I don't know, it was probably February of this year, I came on this radio show and I told you guys, be careful of the biotech sector. It's in a bubble. Tech sector is in a semi-bubble. And this is exactly the reasoning behind it. All right. When people get scared, when investors get scared, when hedge funds get scared, they're not going to look at the long-term value. They're going to say, listen, if this thing is going to drop, if they don't come out beating every sizable metric out there, then we're just going to get rid of them. We're going to sell and ask questions later. And for instance, with FireEye, which I actually got caught in this one. FireEye beat on revenue, beat on earnings, but their guidance was a little weak. They lowered their guidance. their stock got decimated, guys. I think it was down 25% on earnings. Luckily, I only had a half position at that point in my portfolio, but ultimately an absolute crush. Now, again, as an investor, this brings me to the next point. Time is of the utmost importance when trading and investing. And this is something we talk about. It's one of the PPT rules, which is our proprietary strategies that we've employed to make ourselves as much money as we've made in this market. Price, pattern, and time. Those are the three factors and the only three factors you need to know to profit. Okay? And time, as Nick and I will tell you, and Nick, my partner at InTheMoneyStocks.com, is the most important of all. And this shows it because at this time, and I'm going to keep using the word time because it's that important, at this time, Chevron can miss on revenue and guidance and all that stuff and still go up. Counterintuitive, right? But it's because time is most important here. On the other side of the coin, you have these tech stocks, which people just don't want to hold at this particular time. And it doesn't matter if they report a good quarter, a poor quarter, guide up, guide down, but they ultimately do not want to be involved here, and they are selling like crazy. So that's something to remember, folks. And this is something that I teach in my small cap webinar. For those of you that like to take small caps, I teach a webinar where you understand exactly which small caps to buy, when to buy small caps, and so forth. But timing in a poor small cap market, you just don't even want to touch a small cap. And that's kind of where we are right now. We're starting to get into it. There's a couple instances where I'll play a small cap for a quick bounce. Now, 2 months ago, 3 months ago, 5 months ago, 6 months ago, you could have closed your eyes and picked any small cap and made money. Now, you close your eyes, you pick even the best small cap, and honestly, it's going to be a tough buy, tough profit-making issue there. So remember that time issue. Now we have a caller, one of my favorites here, Craig from Hernando. How you doing, Craig? Good to talk to you.
Hey, Garrett. Nice to talk to you. Hey, listen, I want to talk to you. I want to say something kind of funny being it's Mother's Day. We were talking about examples of stuff, and I just found another reason why to avoid a stock. You know, I've been following CNTF, and I bought it, then I got rid of it, like, on your recommendations, and, you know, now look where it's at. So just out of curiosity, I had a little time on my hands. I called up CNTF Investor Relations. They have a stateside investor relations guy named David Pasquale who runs the company. You know, that's their investor relations guy, right? It was either 2 or 3 times I called him. He was too busy to talk to me. You know why?
Why is that?
You're going to laugh, and I am not lying to you.
Okay.
He was changing diapers.
Oh,
now, I want to ask you a question. When was the last time any of you people out there called up Apple Investor Relations, Google Investor Relations, General Electric, and they told you, well, we can't talk to you right now, we're changing diapers? Are you kidding me? So what does that tell you?
Right.
He didn't have time to talk to me. I believe they're in trouble, and rumor is they're in trouble.
Right,
and
right.
So there's a sign. There's one big sign right there. Of course, he didn't play his cards very well, and he showed his hand. And there's a prime example of why to stay away from a stock.
Right. No, you're 100% right about that. And I mean, if you call a company and that's the situation of why they can't talk, that's not
I'm changing diapers. I can't talk to you. My God, if I ever talk to investor relations at Apple and they're telling me they're changing diapers over there, I'm out of there, buddy.
Yeah, it's a great point. That is a great point.
I thought I'd add a little levity to the show, but what I've told you is the God's honest truth. And by the way, he can be found on the internet, the investor relations guy.
Yeah, that's a great. Thank you for passing that along to us. Appreciate that so much. So, I mean, that's a great point there. I mean, you know, and listen, in all fairness, a small cap is a small cap. There's a reason why it's a small cap is because it's trying to make it. When Nick and I started InTheMoneyStocks.com, and we started it literally with $500. $500 we put into the company. We built the website ourselves, and by the way, we are not tech savvy at all. So I mean, it looked like about the poorest website you could see out there, and that's what we had. I mean, when we started it way back in 2007, that's all we could do. So I mean, you know, that situation. I mean, definitely, if it's a NASDAQ traded stock, I mean, they should be able to have a little bit of a better investor relations, and that's where it trades on the NASDAQ. But you know, these companies that are small caps, when you're investing in them, this is why I always encourage everyone who's investing in small caps. You can make a lot of money on small caps, a huge amount, but you have to know what you're doing because it is dangerous. Okay, and I still remember, you know, CNTF earlier on, you know, had a great run up, and then we said get out of it, and Craig did, which is great. And the stock since then has fallen literally about 50%. Now, there will be a point in the future where I most likely will be an investor in CNTF again, but I don't know when. And when the chart tells me to, that's when I'll do it. So, and also, as I said before, timing. Timing is very important. So when the time is right, basically small caps run at the height of a bull market. When small caps start to fade, that's when a bull market is coming to the end. And that's one of the best indicators in the future for you guys to pay attention to. And if you've noticed, in 2013, these things were on fire. I mean, literally so much money to be made on small caps. But now in 2014, most of them had fallen back already. They're leading the move down. Now, why? Because small caps are the biggest area of spec money out there, speculative money. Right? If you're going to invest in a CNTF or if you're going to invest in another small cap out there, you have to understand that you're betting that this company is going to make it, while the opposite would be it fails. I mean, we're not talking about an IBM here who might make $2 a share or might make $1.90 a share in earnings. We're not talking about that. We're talking about this is a small cap because they have nothing out there that's making them a lot of money yet, and they're just hoping to hit a home run, just like a biotech. And this is why each and every one of you guys, if you're going to trade small caps, trade them for the short-term move. All right? Now, you're going to be wrong sometimes anyways, but if you're going to trade them, do not marry it. Because, as I said, and we talked about this with Craig a month or so ago, maybe even a couple months ago, these small caps, yeah, they could be the next Apple, they could be the next Google. The odds are there aren't. I mean, that's like 1% or maybe a 0.5% chance that they're going to turn out to be like that. So that means you got to invest in 99 clunkers to hit one Apple. And the question is, when you invest in 99 clunkers, how much money do you have left to invest in that 100th that's going to be the next Apple? $1, $2, $10, $100. You know what I'm saying? So use small caps. I always say this, use and abuse small caps. When they're hot, play them. And as soon as they get you some good money in the bank, like a 30% move or a 50% move or a 20% move, take your money and look for the next one. And again, once the market sours on small caps like it is now, stay away from them. No reason to push your money in unless you find an amazing setup. And, listen, every once in a while, and even in a poor market, I'll say, listen, this stock, based on what I think here and this, and it's trading at the dead lows, maybe I'll take a shot. But when I do that, I understand that there is insane risk involved, and I'm treating it like an option. I'm treating it like, hey, listen, it's a gamble. I'm going to the blackjack table, I'm putting $100 on it or $1,000 on this hand, and I could double my money or I could lose it all. And that's the mentality that you need to do with small caps. And, it's very important. I was going to talk about small caps a little bit later, but I think it was a great option to talk about them right now with Craig bringing that up. And isn't that insane? So, I mean, it goes to show you guys, your chart could trade on the NASDAQ. You just don't know what the people that are helping that company are doing, actually. And in this case, changing diapers and can't talk for investors' relations sakes. I mean, I'm impressed he actually picked up the phone. Because I've called small caps before, and they just ignore the phone, and it just goes to a message machine that's full. And that's another poor sign. I mean, if you can't get someone on the phone, that's definitely something that you should be worried about. Okay? All right. So great stuff there on talking about small caps and the perils of being in a small cap. We were talking about how money flow, again, is moving out of high tech, out of biotech, and all the rest of them. The one thing I do want to mention, that all these biotechs and all these technology stocks that are getting absolutely hammered, there will be a point, and this is important, there will be a point where they become a good buy. And we talked about it last week with Nick a little bit, like, for instance, LinkedIn, LNKD. Now, LinkedIn on Friday did rally a little bit off its lows after putting in a bottoming tail on Wednesday. And a bottoming tail, by the way, is a bottoming signal. My only issue with that bottoming tail is that it came at gap window and not at gap fill. Nick and I both would like it to get to gap fill because that's the safe area. And I think that's important to understand. In a market where we think the markets are generally going to go lower and maybe sharply lower, I don't care if a stock looks mediocre to play on the long side or buy. I'm going to wait for that safer area. So with LinkedIn, for instance, nice bottoming tail, probably tells us it's going to have a little bit more short-term upside, but I'm going to wait to pick up that swing trade position for myself on LinkedIn around the 125, 126 area. It's only about $20 down move, $22 down move from current levels, which is a little over 10% at this point. But patience and discipline, unbelievably important when you're trading and investing in stocks. All right, so again, nice level on LinkedIn. We want to reiterate that one this week just in case next week comes. I told you guys about Pandora. If the markets get soured in the coming weeks and we see a market sell-off and Pandora go lower, look for $18 a share. Big level at $18. Okay, and the next level, by the way, and I'll just mention this as long as we're talking about it, Pandora has another major level at $15. So 18 and 15 are the two major levels there. You should get a good swing trade bounce off both levels. Okay, and again, remember, in this market, I'm a believer that if you're going to go long a stock, I don't care if it's a small cap or a large cap. I'm staying away from small caps right now, but even let's talk large caps. You want to be in, you want to get your 10% in a week or two, and you want to be out. And that's the way to trade. I mean, so many investors, they're happy with a 10% return in their portfolio every year. They're thrilled. Now, granted, last year they obviously wanted more because the markets were up huge. But in general, if you look over the last 20 years, 30 years, 40 years, 10% a year is what most people are making. In fact, this is funny. Hedge funds are underperforming the market and barely making any sort of money. Even last year, I think the average hedge fund pulled in less than 10%. So, I mean, this is what we're seeing here. These funds are performing poorly. Average investors are expecting 10% all year long. If I made 10% in my portfolio for a year, I'd honestly go cry. That's not acceptable. Not for the risk you're taking. You got to be looking at making multiples of that. In fact, as I said, one stock, 10% in a week or two. Let's find another one, 10% there, 10% here and there. Just keep adding those up. And that's what we do at InTheMoneyStocks.com, folks, and why it's a no-brainer for you to come and just take the 7-day free trial. I mean, it's a free trial. I mean, if it's free, it's for me, right? Check it out. It'll blow your mind. All right. A couple other things I want to discuss here today, and we're going to take another break in just a minute here. But before we do that, I want to talk about what's coming up in this coming week in terms of economic numbers that I'm going to be watching for. And we'll talk if there's any big earnings and what to look for. So right now, the latest headlines over the weekend, Eastern Ukraine is casting votes to become independent and ultimately join Russia. Putin distanced himself from this last week, which gave the markets a little bit of a short-term bounce intra-week. Ultimately, it didn't hold because we all think he's talking out of both sides of his mouth anyways. But right now, there's a huge turnout for this vote, and it looks like it's going to proceed. So we'll have to see how that all comes through. I don't think anyone's going to recognize it. Even Putin seems to be distancing himself to try to keep sanctions, which I actually think are starting to have a little bit of an impact there. Again, they're targeting all the big players around Putin with big sanctions, and I think they're probably putting pressure on him a little bit. And I don't think there's much benefit to Russia taking over. I mean, Crimea was one thing. It's right on the coast there. It's a great location for shipping and everything else. There's a reason why I could see Russia wanting that. Eastern Ukraine, I just don't see it as a benefit. For the issues and the sanctions it's going to cause Russia, I don't think there's a positive there. So, my thought process is that that's probably why Putin's stepping away a little. He's not seeing it, but I think it's too late. And I think he already sowed the seeds, and, who knows, he probably just wants to create instability there anyways. But that's something you want to keep an eye on this week. We'll see if it has any impact on Monday. CPI and PPI numbers are important here. All right, so this week we're going to be looking at CPI and PPI. That's Consumer Price Index and Producer Price Index. I believe on Tuesday, Wednesday. Wednesday we'll get Producer Price Index, which is a gauge of inflation. So remember, as the Fed has printed $4 trillion over the last 5 years or so, when does inflation start to show itself? Now, last month we saw a little uptick in inflation. Do we see it continue? I mean, one time, you can write it off. All right, no big deal. It was just a one-time event. And that's what most of the analysts out there did. If we start seeing it 2, 3, 4 times in a row that we're seeing an inflation issue that's creeping into the landscape, that could be a major impact. Because remember, inflation means down the line, once you get to the Fed mandate of where they want to be at inflation, which is like 2%, they're going to have to start raising interest rates. And if inflation is faster, guess what? They're going to have to raise interest rates faster. And that will be a huge hurt for this market and the economy. So watch the PPI numbers on the producer side, how much inflation's there. And then on Thursday, the CPI, Consumer Price Index, how much inflation's on the consumer side. All right, so again, we all know that there's plenty of inflation in food and energy. I mean, listen, you go to the store, you end up spending hundreds of dollars to feed your family for the week. But we want to see what these are the numbers the Fed is going to cue off of for whether or not to raise interest rates earlier than later. So again, CPI and PPI numbers Wednesday and Thursday. That's what you want to follow. Other than that, earnings-wise, pretty much earnings are over for now. And we're going to look for a range in this market and see if it breaks. Now, when we come back, folks, I'm going to go into some educational pinpoint action, which will help you guys in the coming week make money. My name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com.
Now back to In the Money Stock Market Action on AMA 20 News. Here's Gareth Soloway.
Welcome back, everybody. Great to be with you again on this Mother's Day, and happy Mother's Day to each and every one of you mothers out there. Number one, as we get into this final segment here, let's talk a little education. What I want to go over is one of the rules that I think is of the utmost importance that will save each and every one of you a lot of money going forward. I've named it the 3-day rule. It's something I came up with. And the 3-day rule is oftentimes overlooked by average investors and even pros as they get so eager to get in a stock when it pops big or if it pulls back. Now, generally, if a stock collapses, let's talk about last week, all right? So you had some stocks like AOL dropping 20% on the day, maybe even more, Whole Foods, FEYE, FireEye. A lot of these stocks just got crushed. And the general kind of feeling from the average investor is, oh man, this stock is at a 25% discount. Let me buy it right away. And that's actually something you do not want to do. And I want to explain the reasoning behind it, and that's how the 3-day rule came into effect. So the 3-day rule states that anytime you have a big announcement that causes a big move in the stock, so it could be up 10%, 20%, 30%, 45%, whatever, or down that amount, you want to wait 3 days before you purchase it or short it. So in this case, if a stock drops 25%, you want to wait 3 days to buy it. If a stock pops 30, 40, 50%, you want to wait at least 3 days to short it. Now, why? Well, anytime, and let's just look at last week, because last week is a good example. We had so many stocks getting crushed. Big names, Whole Foods, AOL, FireEye, and so forth. And the reasoning behind this is, and this is important, is that when a stock drops big, you're going to have a trail of institutions dumping that stock in the coming days. In addition, you're going to have margin calls. You're going to have individual investors that just throw the towel in. And the amount of time that it takes for all of those players to move out will be approximately 3 days. All right, because remember, the first day, what's going to happen? Well, the first day, you're going to have a big crushing, and a lot of people will exit the stock. But over the next 3 days, you're going to have margin calls hitting on people that had big positions in that stock. And margin call is where your broker calls you up and says, hey, listen, you're on margin, you've borrowed too much money in this stock, and now you've got to get out of some of this stock to cover your margin call. Okay, and it's basically they're forced to sell that stock. So you have that follow-on selling that's going to take place. And what you'll notice if you look at almost every chart out there on a big drop, it usually, not always, but I'd say 8 out of 10 times, it will continue to slowly slide for a few days before it finds that base. So remember this going forward, folks. When you see a stock hammered and you're interested in buying it, give it that 3-day rule. Let all the sellers, because what you want to do is you want to let all the sellers get out of that. Let them sell, because all the selling is going to do is make it cheaper for you to buy. It's going to give you a better entry point. And then after that, it doesn't mean necessarily you have to buy it, but then start evaluating your factors. Start saying, all right, well, after 3 days, now let's look at the chart. Okay, the chart's at a double bottom, or maybe the signals here in the chart, moving averages, whatever it may be, they're finally telling me it's at a level here, and now I'll take a stab at it. But remember, the 3-day rule is of the most importance here. And I'm going to try to give you guys in the coming weeks a little bit more education as we go on and try to have you understand ways to get the best entry prices on stocks when you buy them, or short them, by the way. All right, a couple other things here. We have a couple questions coming in from InTheMoneyStocks.com members. And David B. is talking about gold and silver and which direction we could be seeing gold and silver heading in the coming weeks, in the coming months. And I'm going to bring up that chart of the GLD, which is the gold ETF. Now, the gold ETF really has chopped for about the last month to 2 months sideways after a pretty big drop. Now, it's been a sloppy chop. It's been up, down, kind of in a weird-looking way. But the one thing you have to remember, anytime you have a big fall from a high pivot, okay, and that's what we got about 3 months ago, where gold just fell apart. It came down basically for 2 straight weeks, almost didn't bounce the whole time. And then since then, we've had these little ups and downs on gold. That's creating what you have to recognize as a bear flag pattern, or an in spirit of bear flag pattern. So the max out, if you're looking out, and this is short-term, listen, short-term gold could pop up on Monday if something with the Ukraine is a little itchy or here or there. But in the longer term, if you're asking me where gold will be in the next 3 months or so, I think gold's going much lower by the chart. And in fact, I'm going to wait patiently And hopefully my patience is rewarded, but I'm going to wait patiently for gold to hit $1,000 per ounce, and then I'm going to start buying like crazy. And I guarantee when $1,000 is hit on gold, no one else is going to want to touch it. Everyone, the media, the analysts, they're all going to be downgrading gold. They're going to be scared of it. The average investor will be too scared of it. That's when I'm stepping in. And I'm buying physical gold. I'm going to load up. Because I'm telling you, down the line, when inflation really does hit this market in a major way, this could be 5-10 years, you will see gold have a major move up. And I'm talking about going through the 1,900 and change level that was the previous high. This thing is going to go probably to 3,000 to 5,000 per ounce. So again, I'm not saying put all your money in it. You always want to diversify out, but take some, and that's what I'm going to be doing, and I'm going to buy some gold there, and I think I'm going to probably pick up some physical gold. All right, so we'll keep an eye on that, but again, 1,000 is my target in the longer term about where gold is going to go. When we're talking about silver's a little bit tougher because it's more of an economic industrial play, and that's something we'll have to kind of keep an eye on here. But overall, I do think that silver could see a little bit more weakness, a little bit more downside in the longer term, but I don't think there's as much downside as in gold, because I do think eventually, even though we're going to see some more recessionist type things going on with the economy, I don't think gold will see too much because you'll also have the buoying up, just like gold will buoy up a little bit off of some of the fear. So I think, again, silver has a little bit of downside perhaps. Gold has much more downside. And ultimately down the line, both are probably a good buy, especially gold, once it gets to $1,000 per ounce. Another question coming in here. Let's take a look. Ramesh saying, Gareth, can you please talk about money management for each trade in the Research Center and the Elite Roundtable? And the Elite Roundtable is another service we offer at InTheMoneyStocks.com where some of our pros, in fact, I'm going to try to have one of the pros there on the radio with me in the coming weeks to talk a little bit about the Elite Roundtable. But bottom line is, that's a great question. Money management, how do you know how much money to put in each trade? Now, my policy, folks, is never put all of your eggs in one basket, right? I mean, that's the worst thing you can do, because even if you're winning at a rate of 9 out of every 10 trades, if you put all your money in that 10th and it happens to go bankrupt, you just basically killed yourself, right? You killed your portfolio. So I don't care how small your portfolio is, guys. And this is a major issue with small investors. If your portfolio is $5,000, only put $500 in a stock. That's it. And you might say, well, I'm not going to make any money there. Well, you know what? You're going to make it very slow, but you're going to make it safe. So put that 10% in, use that 10% rule. And again, this way, yes, remember, small investors always want to get rich fast. If you look and you want to model your portfolio after the big boys, you want to model your portfolio after the Warren Buffetts, I mean, look at his portfolio. Does he try to put all his money in one basket? No. You have to do it slow. And if you do it slow, in 5-10 years, you will be hugely successful and be able to, I mean, remember, the more money you make, slow and steady, the more money now you're investing. So if my portfolio goes from $5,000 to $10,000, well, guess what? Now I'm putting $1,000 in each play. And when it's at $100,000, that's $10,000. But you have to do it slow. You have to do it right. You have to be keyed into that, folks. Because if you throw all your money into one investment, and I've done it, and this is why. I mean, I can speak from my early days and my mess-ups. This is key, guys. Remember that. So I'm going to leave you with that thought. Thank you for the questions in the Money Stocks members. Happy Mother's Day to all you mothers out there. Happy Mother's Day to my mother. My name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio. Take care.